Hello everyone, my name is Mahan Veisi and I am here to present our work titled A Deep Reinforcement Learning Approach Combining Technical and Fundamental Analysis with a Large Language Model for Stock Trading. I'd like to acknowledge my co-authors Sadra Berangi, Mahdi Shahbazi Khojasteh and Dr. Armin Salimi-Badr from Shahid Beheshti University. Together, we developed this model to address key challenges in stock trading by integrating technical indicators with sentiment analysis, enabling dynamic adaptation to market conditions with real-time sentiment insights. Here's an overview of the topics I'll cover. We'll begin with an introduction outlining stock trading challenges and the role of machine learning. Then we'll move to the problem statement where I'll highlight key gaps in existing approaches. Next, in the methodology section, I'll explain our approach of combining reinforcement learning with sentiment analysis for better decision making. After that, we'll review the results, showcasing our model's effectiveness compared to others. Finally, I'll conclude with a summary of our findings and contributions. Our research addresses the key challenges of stock trading, the market's complexity, volatility, and the limitations of traditional rule-based strategies that struggle with real-time adaptability. Machine learning, particularly deep learning, has proven effective for creating autonomous trading agents that analyze historical data to make informed decisions. However, these agents often miss out on subtle market sentiment cues that impact prices. Reinforcement learning advances this field by enabling agents to make sequential, reward-optimizing decisions. This means learning from both successful and unsuccessful trades, allowing continuous improvement. Our approach combines these elements into a hybrid model LSTM PPO with FinBERT. By integrating financial news sentiment with technical indicators, our model gains a richer understanding of market condition, resulting in more robust and adaptive trading decisions. Now, let's take a closer look at the challenges and the limitations that our work aims to address. First, stock trading is inherently challenging due to the unpredictable market dynamics and the limited adaptability of traditional trading methods. The volatile nature of market means that strategies need to be dynamic and responsive to sudden changes. Traditional approaches often fail to capture this level of adaptability. Second, we reviewed existing approaches and found some notable limitations. These include rigid rule-based systems that lack flexibility, making them unable to respond effectively to rapid market changes. Over-reliance on technical indicators alone, which means they miss out on other valuable insights, particularly those derived from market sentiment. The absence of sentiment analysis integration, an essential element given that the market sentiment often influenced by news can drive price changes just as much as technical factors. In terms of existing models, popular ones like PPO and CLSTM use deep reinforcement learning and recurrent networks respectively to improve decision making, but still fall short in adapting fully to real-world complexities. Other models such as TD3 and various ensemble approaches attempt to combine techniques but still rely heavily on traditional data sources without leveraging sentiment. Our methodology frames the stock trading problem as a partially observable Markov decision process or POMDP, which is essential since in real-world trading we don't have full visibility into all factors affecting stock prices. The POMDP framework allows us to work effectively with incomplete information by modeling the environment with states, actions, transitions, rewards, and observations. In this framework, states represent the information available to the agent at each step, like historical prices, sentiment scores, and market indicators. Actions are the decisions the agent makes, specifically buying, holding, or selling stocks designed to optimize returns while managing risks. Our reward function is central to the agent's decision-making, aiming to maximize portfolio growth while penalizing risky action. It calculates the difference in portfolio value before and after an action, capturing the value change due to stock holdings over a period. To account for realistic costs, we subtract a transaction cost of 0.1%. We also introduce a drawdown penalty, penalizing large deviations from peak portfolio value to promote stability, an innovative aspect that mitigates risks specifically in volatile markets. For optimization, we use proximal policy optimization or PPO, which is well suited for finance as it balances stability and flexibility. PPO uses a clipped objective function to keep policy updates within a safe range, preventing drastic shifts. By taking the minimum of the clipped and unclipped objectives, we create a stable learning process that avoids aggressive changes. Finally, we employ an advantage estimator crucial for PPO updates. We use generalized advantage estimation or GAE to compute this advantage, combining past rewards and current value estimates to balance bias and variance, ensuring stable learning over time. Together, these components allow our agent to navigate stock market uncertainties effectively, balancing explorations and cautious updates to develop a robust trading strategy. We'll dive into the core architecture of our hybrid LSTM PPO model with FinBERT, combining technical and sentiment analysis for informed trading decisions. Starting on the left, we have our data inputs, which includes 2,642 days of historical data from 30 US stocks. For market data, we calculate 7 technical indicators per stock, such as relative strength index and moving average convergence divergence, giving us 210 features per day across all stocks. For sentiment data, we process daily financial news through FinBERT, a large language model fine-tuned for financial text. FinBERT generates 768 dimensional embeddings per news, which are averaged daily to create one representation per day. These data streams combine into a comprehensive observation feature vector. Given the complexity and partial observability of the stock market, we model this as a partially observable Markov decision process and use a sliding window of previous days to provide temporal context, enabling more informed decision based on recurrent trends and sentiment shifts. This architecture captures both immediate and delayed effects, balancing short-term rewards with long-term strategy. By integrating technical indicators and sentiment data, this hybrid approach creates a robust and adaptable trading strategy. As discussed previously, our model combines market data and news embeddings for a comprehensive view of market conditions. Now, let's examine how this information flows through the architecture. At the core of our model, we have two separate LSTM networks for the actor and critic components. The actor LSTM processes the input data to generate actions, specifically the buy, hold, or sell decisions for each stock. Meanwhile, the critic LSTM evaluates these actions by estimating their expected future rewards, guiding the actor toward more profitable decisions. Following each LSTM, we have two fully connected layers with 64 units, activated by 10H activation function. These layers allow the model to capture complex patterns in the data. For the actor, the final output layer produces 30 possible actions, corresponding to the portfolio of the stocks. For the critic, the output layer provides a single state value representing the estimated reward, which influences the actor's learning. This LSTM PPO structure allows the model to dynamically adapt, integrating both short-term signals and long-term trends. We use data from 30 well-known US stocks across various industries, providing a diverse dataset to evaluate our model's robustness under different market conditions. For training, we experimented with different hyperparameter combinations to achieve stability and performance. The learning rate was set to a low value, allowing gradual adjustments. We trained in batches with multiple epochs per update to balance learning efficiency and computational load. Our discount factor emphasizes long-term rewards while the GE lambda parameter balances immediate and future rewards, stabilizing policy updates. We also implemented a clip range in PPO to control policy updates, ensuring stability and preventing sudden changes. Additionally, the critic coefficient and maximum gradient clipping were adjusted to maintain a stable training, making the model adaptable to market complexities and resilient to volatility. To evaluate our model, we used 5 key metrics. Cumulative return measures the overall profit by calculating the percentage increase in portfolio value from start to end. Max earning rate highlights the highest profit potential during the trading period. Maximum pullback tracks the largest drop from a peak to a trough, helping assess the maximum loss risk. Average profitability per trade provides the average return per trade, indicating expected profitability. Lastly, Sharpe ratio evaluates risk adjustment performance by comparing returns to the level of the risk taken. Together, these metrics offer a comprehensive view of both profitability and stability of our trading strategy. Moving out to our results, we examined the impact of different observation window sizes, 5, 10, and 20 days, on model performance. The 5-day window yields the highest cumulative return, around 134% by January 2020. This short window captures short-term market changes well, making it suitable for aggressive gains, though it brings higher volatility and increases risks. The 10-day window strikes the balance with a cumulative return of approximately 101%. It shows a steady performance, specifically between mid-2017 and mid-2019, balancing returns with moderate stability. Lastly, the 20-day window provides the most stable growth, achieving around 110% by the end of the period. With the lowest volatility, this longer window smoothes out the market shifts but limits responsiveness to sudden opportunities. We then compared the performance of our LSTM model against several established models such as A2C, PPO, an ensemble model, CLSTM, and TD3. The A2C model demonstrates steady but modest growth, yet it struggles to adapt to volatility, leading to limited long-term performance. PPO shows similar early trends but performs poorly during market shifts due to its clipped objective function, resulting in the lowest cumulative return. The ensemble model achieves stable growth with lower volatility, though its returns remains limited as it misses high profit opportunities. CLSTM experiences inconsistent gains and high volatility, reflecting its difficulty in adapting to complex market conditions. TD3 performs better, benefiting from sentiment analysis that enhances resilience to market shocks. However, despite the strong average profitability per trade, it does not make the overall success of our model. Our LSTM PPO model consistently outperformed all others, specifically from 2017 onward, achieving the highest cumulative return and Sharpe ratio. This demonstrates its ability to balance profitability and risk effectively, adapting well to both short-term fluctuations and long-term trends. In summary, our research introduces an innovative approach that integrates technical indicators and sentiment analysis with a deep reinforcement learning framework, enhancing decision-making in stock trading. This combination enables our model to adapt to market data and sentiment shifts, creating a more resilient trading strategy. Our results showed a strong performance with our LSTM PPO model, surpassing other established models in cumulative return, Sharpe ratio, and profitability per trade, demonstrating effective risk management alongside higher returns. Looking ahead, we plan to incorporate social media sentiment data to enhance the model's responsiveness and optimize the reward structure for improved risk management in volatile conditions. These future steps aim to further strengthen our model's robustness and adaptability. Thank you for your time and attention. I hope our work has provided valuable insights into the potential of combining technical and sentiment analysis in stock trading. I'd be happy to answer any questions.